Hello, everyone, and welcome to this episode of Ignition Time. The number one factor that influences the economy that the Federal Reserve just talked about and they'll speak about again in March of this year is the interest rate at which bonds pay out interest. The short-term interest rates, which are actually controlled by the Federal Reserve of the United States of America. I'll explain what this means and how this has an impact on your future and how it is all tied back to supply and demand, back to inflation. Welcome to this episode of Ignition Time, everyone. My name is Dr. Nitin Chhoda. Please click the like button, please click subscribe, and please enable notifications. So, there is an inverse relationship between bond yields and the stock market. There's generally an inverse relationship between bond yields and inflation. What does all this mean? Let me make it as simple as I can for you. When you buy a US Treasury note, when you buy essentially a bond from the US government, you get a fixed rate of interest from the US government. You can buy a bond that could last for 2 years or that could last for 30 years. Think of it almost as a CD, a certificate of deposit. It's basically money that you lend to the US government, and in exchange, the US government pays you some interest. Now, when bond yields go up, it becomes more expensive for businesses to borrow money. Your credit card interest rates go up. Getting a mortgage now becomes a little bit more expensive. Overall, consumer spending does tend to slow down when bond yields go up. Can stocks pay you a higher interest rate than a US bond? Yes, they absolutely can. But you know what's been happening to the stock market lately. A US bond is not going to decline in value by 50%. Well, at least it shouldn't, because if it does, I think the whole world is in trouble. That's a separate conversation. But the stock market could definitely decline by 50%. On the other hand, you're not going to see that sort of stuff happening with US bonds. So what happens is, as a direct result of any economic crisis, I'm talking about the 2008 financial crisis and of course the pandemic in March 2020. And then as a direct result, the Federal Reserve cut interest rates to 0%, close to 0%, and left it there for a prolonged period of time. As a result, there were no returns available with US bonds. And so a lot of people, because they were not getting a return from US bonds, simply invested and essentially plowed money into the stock market. As a result, we saw all-time highs multiple times in 2021, but now the party is over, because now as the Federal Reserve decides to start raising interest rates, the stock market is taking a dive, because a lot of investors are saying, hey, wait a minute, why should I invest in the stock market when my portfolio value can go down? Why don't I simply buy a US bond if it's paying me 2%, 3%? Now, 2%, 3% may not seem like a lot, but guess what, folks? If it's guaranteed and if you know your underlying principal is safe, then that is something that a lot of people like to do to hedge their position. Some people buy gold, and some people who are a lot more aggressive tend to buy cryptocurrency, although I wouldn't allocate more than 1 to 3% of my portfolio to cryptocurrency. It's still an evolving asset, and as you know, Bitcoin has taken a huge dive lately. But here's the important part. When bond yields go up, when the Federal Reserve raises short-term interest rates, which they will do this year multiple times, then it becomes more attractive for an investor to essentially invest in US bonds relative to the stock market. That's when the stock market goes down. Now, when bond yields go up, it becomes more expensive for businesses to borrow money. Your credit card interest rates go up. Getting a mortgage now becomes a little bit more expensive. Overall, consumer spending does tend to slow down when bond yields go up. But this is not necessarily a bad thing, because one of the reasons we have inflation is because of high consumer spending. Let's keep this simple. As a direct result of low interest rates during the pandemic, and as a direct result of all the stimulus that has been injected into the economy, consumer spending is up. Because consumer spending is up, supply cannot keep up with demand, and that's why prices are going up. That's why it's costing more to buy milk, to buy eggs, to fill up gas in your car. And as a result, prices go up. This is inflation. Inflation is a direct result of the loose monetary policy we've had. Inflation is a direct result of the low interest rates and all the stimulus we've had. I'm not saying this is good or bad. I'm simply saying that this is a fact, and this is the economics of the situation that we are in right now as a country. Remember, the Ignition Time channel is about the country, the economy, as well as our money. Now that bond rates are going to start to go back up, people are going to want to buy US bonds, pull money out of the stock market. People are going to have to end up paying more for mortgages, more for credit card interest, and more for loans that they take, or loans or any money that they borrow from a bank. as a direct result, consumer activity is expected to slow down. And this means that demand will actually reduce. And when demand reduces and when supply gets a chance to catch up with demand, that's when prices can cool off and that's when inflation can come back down. So this, folks, is a direct link between bond yields and the economy, because there's a direct relationship between bond yields, which are directly affected by short-term interest rates, which essentially is something that is controlled by the Federal Reserve, and the Federal Reserve will raise short-term interest rates this year. So all of this, I want our viewers and subscribers to know, is an economic cycle. This has been going on for many, many, many years, and it'll continue to go on in the future. We have been in an environment of low interest rates. That is why the stock market surged. Now we are no longer going to be in an environment of low interest rates, which is why the stock market could and will see a major correction. You want to be in safe stocks. You want to be in stocks in companies that are continuously generating money. You don't want to be in speculative stocks or speculative assets which don't actually generate any revenue. You want to be in a situation where your cash is protected. Cash is definitely king in an environment like this, and I believe cash is king at all times. I also believe you should have 6 months of your monthly expenses set aside as an emergency fund, and anything extra that you have, you can either invest it in real estate, you can buy bonds, or you can invest a portion in the stock market in stocks that you know, that you love, and whose numbers you understand. This is absolutely crucial in the new economy that we live in, because I want our viewers and subscribers to first and foremost protect their money. And now, as bond yields go up, it's more and more important for you to protect your money, perhaps even buy some US government bonds that will pay you a guaranteed rate of interest. Now, that interest may not be much, maybe 2%, 3%, depending on when you watch this video, but the important part is your underlying principal is guaranteed by the US government. It's not going anywhere. You will get that underlying deposit back, including that nominal rate of interest. Now, should you settle for 2%, 3% for all your money? Absolutely not. I believe your money should be spread across different sectors in the stock market, technology, healthcare, banking, energy. Your investments should be diversified. And if you want me to do more videos on how you can invest in the stock market, how you should diversify your investments between stocks and bonds, where to buy stocks, where to buy bonds, let me know in the comment section below and I'll be happy to help you. Thank you so much for watching, everyone. My name is Dr. Nitin Chhoda with Ignition Time. Please click the like button. Please click subscribe. Please enable notifications. I appreciate you. Please also follow me on Twitter. This right here is my Twitter handle, ignition_time. That's ignition_time. Thank you so much. I'm looking forward to seeing you in the next episode of Ignition Time. Take care. Bye.